Is the SUD Life e-Wealth Royal Plan truly a royal path to wealth creation or just another ULIP dressed in grandeur? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So this is a unit linked life insurance plan. So some of the key features of the policy are it provides you with life insurance protection along with wealth creation throughout the policy term. You have the option to choose between platinum and platinum plus variants, and you get access to 11 different fund options to match your risk appetite, and you get to enjoy loyalty additions starting from the 6th policy year and wealth boosters from the 10th year, enhancing your investments. Up to 12 fund switches allowed every policy year at no extra cost, and there is facility of partial withdrawals available anytime after completing 5 policy years, and you're eligible for deductions under section 80C on premiums paid under section 10(10)(d) on maturity proceeds as per the Income Tax Act 1961. So there are riders and maturity benefits, survival benefit, death benefits, return of charges, which all depending based on the plan variant you have opted for. And there are also 2 unique investment strategies that can be chosen by the policyholder at policy inception. And there are also 11 fund options which you can see in the policy brochure. They have categorized based on the risk profile and how much fund option is allocated to different asset classes. So based on that, you can choose if you want to invest in what kind of fund option. So these are all the features of the policy. But as a unit link policy, there are also some charges like policy administration charge, fund management charge, surrender charge, switching charge, partial charges, so mortality charges, additional risk benefit charge only if platinum plus variant is opted for. So all these charges act as an additional cost for the investor. Unlike most other equity related investment option where such costs are absent, these charges can gradually erode your returns over the long term period, which you need to consider the drawback. So some of the advantages are your premium is invested in the chosen funds with no allocation charge, your mortality charges deducted during the policy or added back to the fund value at maturity, no administration charges from the 11th policy year plus a return of charges at the end of the 10th year. You have the option to extend both the premium payment term and policy term. You have the option to receive your death benefit in installments instead of a lump sum. So these are some of the advantages. However, the disadvantages are funds cannot be accessed during the first 5 policy years, additional premium contributions are not allowed, net premium is invested only after deducting applicable charges, the sum assured offered may not be sufficient to meet protection needs, and overall returns are comparatively less attractive than alternative investment options. So now, as we have a basic idea about this policy, let us move on to the analysis part of the video. If you want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. So now, to make more informed decision, we are going to conduct an IRR analysis. So to help us calculate the internal rate of return, we are going to conduct the IRR analysis based on the benefit illustration given in the policy brochure. So for calculation purpose, let us assume that a 35-year-old male purchases this policy with a sum assured of 5 lakh and a policy term of 20 years and a premium payment term of 20 years. So he pays an annual premium of 50,000 rupees and he has chosen the platinum variant. By paying premiums regularly, the policyholder is eligible for the fund value at maturity. However, in the policy brochure, the assumed return rates are at 4 and 8% per annum, which are purely just for example purpose. These are not guaranteed returns and may not represent actual market performance. This is just to show you how this policy can perform at both extremes, like in the worst case and in the best case scenario. So at 4% return, the fund value is 13.83 lakhs and IRR is 3% as per the policy's maturity calculator, and at 8% the fund value is 21.62 lakhs and the IRR is at 6.88% as per the policy's maturity calculator. So even in the higher return scenario, the IRR is on par with or sometimes lower than returns from traditional debt instruments. So considering this is a market linked product, its returns should ideally beat inflation and outperform debt based options, but they fall short when compared with other equity oriented investment. So some of the key concerns are inadequate life cover because the sum assured is too low to provide meaningful protection, high charges because these eat into long term returns, and lack of transparency because limited clarity on how investments are managed, and subpar returns because even optimistic projections don't justify the market linked risk. So this policy offers low coverage, high charges, and underwhelming returns, making it an unattractive choice for long term financial planning. So as this policy is not giving us a desirable outcome that we need, which is especially inflation beating returns and liquidity, we are going to conduct a comparative analysis in which we are going to explore an alternative strategy. So instead of investing the same premium of SUD into a policy where it combines insurance and investment, we are going to invest in it separately. So we are going to split the premium and invest in life cover and investment separately to see whether that can yield us better returns. So for life cover purpose, we have opted for a pure term insurance policy with a sum assured of 5 lakhs, which cost us only about 3000 rupees per year as a premium for a 20-year policy term. And instead of investing 50,000 rupees annually in the ULIP, the remaining 47,000 rupees saved each year can be invested according to one's risk appetite. If you are a high risk investor, you can allocate funds to equity based instruments, while risk averse investors can opt for debt instruments. We are going to consider both scenarios in this video just to show you how it can perform. So option 1, we have taken up a combination of pure term plus PPF for debt focused. So annual investment of 47,000 in public provident fund gives you a maturity value of 20.86 lakhs with an IRR of 6.58%, which is completely tax free. So even this debt instrument outperforms the ULIP's return projection with guaranteed returns. So option number 2, we have taken up a combination of pure term plus equity mutual fund for equity focused strategy. So annual investment of 47,000 rupees in a diversified equity mutual fund gives you a pre-tax maturity value of 37.92 lakhs. So the post-tax value after capital gains tax is 34.51 lakhs with an IRR of 10.74%. So this return is significantly higher than the ULIPs, even the best case scenario. So separating insurance and investment not only delivers you with better returns but also ensures adequate life cover at minimal cost, transparency in investment allocation, greater flexibility to choose suitable products based on risk appetite. These advantages are what's missing in the SUD policy, making the separate approach a smarter financial choice. So what is the final verdict now? Is investing in the SUD Life eWealth Royal plan worth it or not? So this plan comes in two variants. The platinum option functions as a regular ULIP, while the platinum plus option includes an additional ATPD benefit and allows the policyholder and life assured to be different individuals. However, the platinum plus variant does not provide any meaningful advantage, rather it only increases the overall cost and charges of the policy. The key drawback of this plan is its inability to outpace inflation, largely due to high charges that eat into returns. This means you may fall short of your financial goals when the need arises. Moreover, the sum assured is inadequate, making the plan unattractive as both an investment and a protection tool, and it also has a high agent commission. So for long-term wealth creation, investment should ideally deliver high inflation-beating returns. ULIPs often fail on this front. More efficient alternatives such as equity mutual funds offer better growth potential at a much lower cost. For life coverage, it is always wiser to separate insurance from investment. A pure term life insurance policy remains the most cost-effective way to secure your family's financial future.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.